Today, we are going to discuss the 7702 update and the impact it will have on loan interest rates with whole life insurance policies. So with this new change, there's been a lot of discussion around the MEC limits, the guaranteed rates, and specifically around the guaranteed rates, what has happened with the new 7702 update. Guaranteed rates on whole life insurance policies since the 1980s have been at 4%. They're no longer at 4%. Beginning 2022, all whole life insurance contracts, new contracts issued, will have a guaranteed rate that will range between 2 and 3.75%. If you already have a policy that has a guaranteed rate of 4%, that will not change. In fact, nothing will change on that. Whatever your original contract language and terms were, you are locked into that indefinitely, which is nice. Now, in respect to the loan interest rates, as those guaranteed rates are dropping, we've seen loan interest rates have dropped as well. So insurance companies are not stating, hey, we're going to reduce the guaranteed interest rates because we have to, and keep the loan interest rates high so we can capture a greater profit potentially. No, they're not doing that, which is nice. So let's go through some information here. We've got loan rates in red are the new rates we're seeing based on different terms, and in gold are the old rates. So for example, fixed loan interest rates. We've seen this with a couple companies, is now at 5%, where it used to be 6%. Example, Guardian used to have a fixed loan interest rate of 6%. And if you have one of their older contracts, you'll be locked into that. If you go further back, they had a fixed rate of 8%. I've got one of those. I'm still locked into that 8% rate. But now, if I purchase a new policy, I will have a fixed rate at 5%. Other companies are adjusting their fixed rates as well. Variable loan rates used to range between 4.5% to 5% depending on the company and product. Now we're seeing them range between 3% and 4%. For example, MassMutual's 10-pay product, only their 10-pay product will have a variable loan interest rate of 3%. But then if we look at a company like Guardian again with their variable loan rate, which we can only opt into in the 10th year of a policy, that will have a variable loan rate and floor of 4%. Where it used to have a floor of 4.5%, and MassMutual used to have a floor of 5%. Now, MassMutual's other whole life insurance products will have different variable loan rates, not the same 3% as the 10-pay product. Now, that 10-pay product will have a 2% guarantee. So kind of see what the company's doing there. The lower the guarantee, the lower the loan rate floor, which is nice. Fixed loan rate here, 3%, age 65, used to be 4%. So specifically that has to do with Guardian, where their contract language, based on their old contracts, starts out with a fixed loan rate of 6%. At year 10, you can elect a 4.5% variable loan rate. If you don't choose it, at year 20 or age 65, whichever comes last, that fixed rate of 6% will drop to a fixed rate of 4%. Same method that the company's using, the difference is now, and this is Guardian specific, they have a fixed rate of 5%. We've got the option to elect a variable loan rate with a floor of 4%, but if we don't, the fixed rate will drop from 5% to 3% at age 65 or year 20, whichever comes last. A lot of information there, but overall, the rates have come down. Now, what's important to note here is if you plan to use your policy heavily, meaning you plan to borrow from it, acquire real estate, invest in business, pay off debt, whatever it might be, all that fun stuff, if it's non-direct recognition, not much change there. With a non-direct recognition company, or policy I should say, the company does not recognize the fact that we take out a loan and you continue to earn the same dividend on your entire bucket of money as if you never touched it in the first place. With a direct recognition contract, however, they do recognize the fact that you pull out money. So let's take a look here and go through an example. Let's assume you have a dividend rate of 5.65%, like Guardian has. And you have a fixed loan rate at 5%. If you don't touch the money, what will happen? Well, you will earn that dividend rate on 5.65%. That does not mean you're earning 5.65%. You won't see that type of growth. Remember that the dividend rate is a gross rate credited after the company's insurance expenses. The IRR might fall around 4.5%. That's your internal rate of return net growth rate. But anyway, my point here is With a direct recognition policy, if I don't touch it, there's the gross crediting rate. If you borrow out half of it, $50,000, you have a 5% cost to borrow. That goes to the insurance company, $5,000. $50,000 is outstanding, $50,000 remaining in cash value. The money remaining in cash value continues to receive a dividend rate of 5.65% because you have not touched that. There's no change there. However, the outstanding money, you're paying 5%, you will still earn a dividend on that. So you still earn dividends on your full $100,000 with a direct recognition contract. The difference is this: the outstanding dollars receive a dividend rate of 5%. So what Guardian does, and their practice has really been this with all of their whole life insurance policies that I've seen for a long time, is whatever the loan interest rate is, when you take a loan, you have that cost to borrow, and then they adjust the dividend rate to match the loan rate. So if I have an old contract with a 6% loan rate, maybe an 8% loan rate, when I borrow, I'm actually getting a higher dividend rate than the company's current dividend rate of 5.65%. With this decrease, where I now have a fixed loan rate of 5%, now what I'll see is if I borrow and repay and compare that policy to an example where I never touch it, I just let it sit and grow over time. When I borrow and repay, I would actually see less money in the policy than I otherwise would have had. And if I'm not comfortable with that, but I like Guardian perhaps for the flexibility, or maybe it's a different direct recognition company, that's where there are other options with collateral loans and such. But my point is, we want to have awareness here. If we have awareness, we don't run into an issue where we do it, we don't know about this reduction, and then we find out about it after the fact. And if you have an old contract, you don't have to worry about this. Let's look at some numbers here. We're going to look at direct recognition and then briefly at non-direct recognition just to show both. But we'll begin with direct recognition. What we've got here is a policy with a 1090 split. So this is based on the new 7702 rules. Whole life insurance contract, $100,000 per year. Year one, about 83% in cash value. Now this is a 1090 split. Why it looks more like a 2080 is due to the higher PUA fee. So companies have raised that. Some companies have, and we have more information on that actually in the prior video. But first year cash value, about 83%. Break even point in this example, year 5. I've paid in $500,000 and I have $500,000. I pay nothing in thereafter. There's your cash value. Now, the dividend rate on this example is 5.65%. And I emphasized this a little bit earlier, that is your gross crediting rate. Why I say that so adamantly, gross crediting rate, is so many times people run into issues where they get a policy, they put their money into it, and they're told, here's the dividend you're earning. That's not what you're earning. Here's your annual internal rate of return, what you're actually earning year over year. So the first year, I've got a 17% hit. Year 2, negative 0.9%, meaning I pay in $100,000. If I look at that cash value, it grows from 82 to 182. To 181. So I get the 100 I pay in minus $1,000. It's not positive. Beginning year 3, it's positive. It gets stronger and stronger from that point forward. The annual IRR isolates what you are earning year over year. When we compare this, when we take out loans and see what am I actually paying compared to what am I earning, it's good to look at each year specifically and then the average internal rate of return as well. So if we look at the 10-year mark, I've paid in $500,000. I have about $625,000, which means I have an average of 2.81%. That is a tax-free yield if the policy doesn't mech out or I do anything else that can trigger a taxable event. And as we look at this over time, tops out at a little over 4% on the average, tops out at almost 4.75% on the annual. Anyway, let's look at the loan and see how this actually works. So the loan interest rate in this example is 5%. Now, Guardian here, this is actually based on them, they actually have a practice where if you pay the loan interest on the anniversary date, meaning you don't let it compound, they give you a discount. If you have a calculator, you'll see this. It comes out to about 4.71%, meaning if you take a calculator, 500,000, 23,810. In fact, we can do this real quick. 23,810 divided by 500,000, 4.76%. Right? So that's the actual net interest cost that I have here if I'm paying the loan interest, which in this example, I am paying it each year on the anniversary date. If I don't pay it, it'll net out to 5%. So annual loan we take here, $500,000. Your cash value, view that as the equity or gauge that determines how much you can borrow. So I took that loan out year 11. I was at 654. Took out $500,000. I'm now at 148. The death benefit was at 1.367. We see it drop by about $500,000. Now in this example, this is with their direct recognition contract. There's my loan balance. Interest that comes due, I pay the loan interest. And then in bold purple, I apply payment toward the principal. This is $50,000 per year. We can pay back loans however and whenever we want. We actually don't even have to pay them back. But what I want to touch on here is when it's paid back, what do you notice here? How much have you paid in total interest expenses? This column tallies up your total payments in interest only, so just north of $130,000, almost $131,000. Your cash value is what once it's paid off? $1,030,000. But compare that to the example when you just let it sit and grow, $1,073,000. So I've got a bit less in cash value than what I would have had if I just let it sit and grow. Good to have awareness on that. Now there are some other things you can point out here as well. For example, I was paying a net of what? About 4.7% in interest, call it. 4.76, was that it? 4.76, yes. Took me a second there just to register that in the memory bank. But 4.76%, what am I actually earning on the policy? This is what a lot of investors want to know if they're using this for real estate, for example. Do I ever hit 4.76% on the annual internal rate of return? No. Have it on the average? No. That means if you do this, it costs you more than what you're earning. Granted, the cost is minimal, you still have a negative spread in reality. Good to be aware of that up front. Now, a lot of real estate investors like this because they look at this and say, hey, this is a great area to store my capital, safe, liquid, tax-free. I can use it whenever I want for other investments, but this cost to borrow is just too high. Even with the reduction, that's where those cash value collateral loans come into play. But this is a direct recognition contract. Let's take a look at a non-direct recognition contract with their variable loan rate, and everything's the same here. Break even year 5, everything we covered initially, but let's go down here and look at the repayments. There's your $500,000 loan. There's the $50K per year repayments, and here's the cost to borrow. So the actual interest rate is 4%, but Guardian, just like their fixed loan interest rate, if you pay the loan interest in advance or on the anniversary date, they do give you a discount there. So it nets out, I believe it's about 3.7%. Point here, here's your interest payments. What was it with the fixed loan interest rate? About $130,000. What did you pay in total interest cost here? About $105,000. And because we flipped over to the variable loan rate, the treatment is non-direct recognition. So what do you notice here about the cash value? $1,073,000. If I just let it sit and grow, $1,073,000, fully restored to exactly what it would have been as if you never touched it in the first place. And the dividend column, I neglected to go over this in the direct recognition. I'll go back. But do you see any change here? When you take that loan out at age 55 in this example, that dividend column reads what? $13,798. And in the growth example, it's identical, $13,798. The reason why, non-direct recognition means the company does not recognize the fact that you take out a loan and they continue to credit the same dividend to any money in cash value and what is outstanding. If we go back to direct recognition, and we'll close with this, when we look at the same point in time, what do you notice here? Look at that reduction. $13,798 in the example where I let it sit and grow because it's the same policy. But now when I take that loan out, I see that reduction there. So right now with this adjustment that the company has made, we do see a reduction in dividends when I pull out funds. And granted, it'll still produce that 3 to 5% net IRR, but this would be a case, especially if I'm looking at a larger loan transaction, where if it's me personally, I would say, okay, I can borrow directly from the policy. It does hurt me a little bit because they kick my dividend rate down. And as I look at the performance, it's costing me more to actually borrow than what I'm earning. So I might look at a collateral loan as an alternative. But having the options helps me make an informed decision as I weigh out the pros and cons. But hope you enjoyed this one. A lot of information there on loan rates and what companies are doing, and then some examples as well. If you did enjoy it, please hit the like button. Please hit the subscribe button. It does help us out. And as always, I do hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.